Hello traders. I know it's been a while since I've done a video. I really want to make sure I add value when I create videos, and I have been still figuring things out. I've had a very inconsistent profits over the last few years through this learning journey. So I didn't want to keep creating videos that really wasn't adding value to your time and my time, and all of us mastering this wealth building journey. So I had a few epiphanies and adjustments that I've made in my trading style that hopefully would lead to long-term gains and financial freedom that I would love to share with you guys. And it also helps me when I look at my videos over the years to kind of see the things I could nuggets I can take out of this journey and really become a really good investor, trader, business owner, right? And so those points are important to keep in mind when you're learning. And my goal with you by sharing is really just so you can not make all the mistakes that I've made, and you can more quickly and more efficiently become good at this stuff. So it's a lot. I'm telling you now, it's a lot of information. So I'm going to try to go slow and try not to assume that you know certain things, and walk you through it, which means this video may become long. So bear with me, and slow it down, rewatch it, and to figure out any questions that you have. So I'm going to try to focus on as much web stuff as possible. I might open up Thinkorswim. I'm still a big Thinkorswim person, old school, to leverage my research. And I've also incorporated some additional tools that hopefully will long term be a good idea, but I don't know yet. I'm still kind of early. All right, so there's a couple buckets I want you to realign your mind to. So when you start trading in the markets, you put on trades that no matter what happens, you're completely okay with. That's my goal. Like, I, when you first start this journey, you want to just get in, and make profits by tomorrow. Get in, and make profits by the end of the week, and you would trade any and everything to accomplish that goal. The problem is, what I realize is, money should drive all your decisions of what you can and can't do. And the problem is, with a lot of these brokers, all of them, they enable you to take on more risk than you should. And what people don't realize is, you say all day long that you're okay with losing money or risking thousands of dollars at a trade, but you're not really willing to do that. And the result of that will mean that you're going to lose a lot more money than you intentionally want to lose. It is very easy in the market to make money. You can throw a dart at anything and it will make you money. The problem is, the reality is, you're going to lose money if you don't manage and plan for loss, or realize in your mind that loss is a real thing. I can tell you firsthand, I've lost lots of money in investing and in option trading. And so I can tell you firsthand, like, it's a real thing. I've lost thousands of dollars on a single trade, right? So I don't want you to go through that. So you need to have your mindset of the following. You need to be okay with being a trader. And you also need to understand the difference between trading and owning a business. I'll say that again. It's important that you understand the difference between when you're trading and you being a business owner. And if you approach every trade with that mindset, you can set yourself up to where no matter what the underlying stock does, you're okay with the outcome. The outcome can be that you were right on the trade and you'll make profits, or the outcome can be that you only trading at a price that you want to own the business at. And if you do that, then you will always be okay with what's going on. Which means you're gonna have to expose your brain to some financial analysis, which I thought I would never have to really do. Understand the business a little bit that you're considering to trade and to own. And you also need to look at some technical analysis to kind of see. And with the full disclaimer that you don't have to do none of this. You could just be a person that identifies some really strong mutual funds and you just buy throughout your life, and then when you get much, much, much older, when I say older, I mean like in your 50s and 60s, that's when you can consider selling things. And you will still end up being a multimillionaire. So don't get it twisted or confused. That is a proven strategy that will result into you being wealthy. But we can have that conversation a whole different time. Today is all about, if in the world of option trading, the mindset. And again, the mindset should be only trade things that you can afford. Now let's start with that. AT&T is one of my favorite stocks. It's a strong company. The financials are strong, and the price is something that any and everybody can afford. So this is what I mean by afford. Don't even consider doing any option trading unless you can afford the actual stock. And when I say afford the stock, I mean 100 shares. If you can't afford that, because I made this mistake. This is mistake number one that I didn't get ingrained into my head until years of option trading, is that I need to stop trading stuff that I can't afford. Because if you can't afford it, you're going to have to take the loss when you're wrong. Okay? So only trade stuff that you can afford. And when I mean afford, I'm like, literally, if you got the money in your pocket that you can right now buy 100 shares, that's when you can consider option trading on it. So a very quick and easy way to know this is if you click on the buy or the ask, and you click it, and you type in 100 for quantity, whatever this number is, when you send it right here, is what I mean. If you don't got that much money that you're willing to buy the stock for today, do not trade this stock. Do not option trade. Don't do anything. But if you got it, now you can consider it. Now here's a cool thing. This math is simple. Stock's trading at like 28.27 or whatever, 28.08 times 100. That gives you this 28.2708. Right? This is on I like my account because I can show. I have both. I have an IRA and I have a margin account. So for a lot of you, you're trading with margin account, which means on margin, on the notional value, you only need about 25-50% to actually own 100 shares, which is amazing, right? So you see how right now it says 28.27, but if I click on my other account, I only need like half of that. So the cost is always is, but because you have a margin account, then you only put a because of margin, you only need like 25% or 50% of your account to hold this notional value of this product, the security, which is AT&T. So those are what I mean. Like, if you could do this today, then you can option trade on it. And why is that important? Well, I am not a option buyer. Not to say I don't buy options. I buy options to support my strategy. But my overall strategy is always shorting or selling options, which means I'm not willing to pay current price, but I might be willing to, under contracts, purchase at a better price than it is today. And that creates the first revenue stream of money that you can make in the market. The other stream is actually owning the stock at a price that I'm happy with, that I think is fair. And when I mean by fair price, there's a lot of sites out there, and one of my favorites to use that I've incorporated in my trading is Morningstar. It is not free. It is an annual subscription. So just keep that in mind. But it's I'm in year one, so I'm not sure if it's air quotes worth it. I think it is, but we'll see. It gives you everything you need. But they have this concept called fair value, right? This is the Morningstar rating, and it's really this Morningstar rating is like their star system, so it's probably like 5 stars. And I didn't understand it until I purchased it and started using it. But fair value basically means like based on the mindsets of Warren Buffett and Benjamin Graham and Charlie McIntyre. You on your own need to go off and research something called discount cash flow. Let me see if I can Google it for you. So DCF, or discount cash flow. And this is basically It's basically it's a model to validate the estimate of the intrinsic value of a company, and that basically just means, and you know, the discounts of a company expected flow in order to arrive at the current value to reflect over time to value. So like you guys are all about buy now and sell it for later, or as a business owner, you you're basically saying, all right, what is a fair price to purchase or be an owner of this company that's going to return you good returns over a long period of time, right? So you got to remember, there's a big difference between you just taking your cash and trading it for a stock or a security today, because the market would happily sell it to you overpriced. You know, because you're impatient, you being impatient, you will happily overpay for something because you want it right now and you want to get your profits tomorrow. And so the market will take advantage of you and make you pay way more than you need to pay for something. So discounted cash flow model is basically saying, all right, we've evaluated for you the the intrinsic value of the company, of any company, based on its financials, its cash flow, and it can over time discount over long period of times of what the present the future value of a company is, and based on that can tell you what's a fair price today to pay for a company. And you're probably like, why is that important? Because this is the distinction between trading and being a business owner. Like you owning a company, you own security ownership, and you are now owner of Snap or Apple or Google or Microsoft. And you want to make sure, like, what is something you can use as a metric to know that you're paying a fair price for a company versus what the market's giving you? Because the market will give you prices all day long on stuff. You can put in anything. There'll be an order book of people buying and selling, and that will create a value based on the market's supply and demand. But, and because you're impatient, you would overpay. We all have. You'll come in too hot, come in too high. Snap's a good example. Like if the market will sell you Snap at $83, but that is way overpriced. It's not like it's going to skyrocket to 200. It might not do that for 50 years. So never overpay. Like why pay up here? You need to find value where it's worth, which is way down here. And this is a good example of what I mean. You know, supply and demand drove it up, and then if you get stuck holding the bag up here and people start selling off, you still up here, which means you've lost 80% of your account. Well, air quotes. You don't lose money until you close a trade. All right, so let's get refocused. So what do I mean? What's the point that matters? Well, you need something to figure out what is a fair price, not what the market's giving you, but you need to know what's a fair price of a product based on all these things, on their how over time the value of supply and demand and their cash flow would determine their price, sustainability, financials, the evaluation, dividend, like all these things matter because you want to buy ownership in the company today. Forget about trading stock market. You want to be an owner of Snap today, and then you over time want to be profitable. You want to not only get your money back, but be profitable in Snap because you feel like this is a good company, right? So, what does that mean? Well, as an option trader, I'm going to consider first, is there any premium or better pricing I can get for a stock? If I go to AT&T right now, I'm going to come in here from a financial standpoint and say like, hey, is AT&T something worth trading and owning? It's always both worth trading and owning, because if it's not worth owning, you shouldn't option trade it like at all. All right, so the first thing I look at is the Morningstar has leveraged the DCF model, which is the discount cash flow model, and they based on that will at your fingertips give you fair value of a underlying. They give it a rating, which is the Morningstar rating. Right now, today, AT&T is trading at a fair value, which means if you buy today, you're not getting taken advantage of. If you buy it at current price, which is $28 today, you're getting it at a fair price. Like they're not taking advantage of you. Now, there's better pricing the 5-star rating for this company is 18, right? And absolutely the lowest over at the very you know marginal line of overpaying is 35. So they've done this evaluation for you, which is great. Another financial I like to use is gross profit margins, right? So you want companies' margin to be over 40, and this is not me saying this. This is a Warren Buffett, Benjamin Graham mindset. Like, if it's over 40, the company has edge in the industry that they're in, right? They have edge over everybody else. So you want this number to be over 40 before you to hold a company in for years and years and years and years. So AT&T is like by far one of my favorites, and they pay dividends and all these different things, right? So winner all day long, right? But even though it's a winner, you still don't want to overpay, right? This is fair, but this is better. So what can we do to get better pricing, right? So if you come into this is where, like, as an option trader, I'm like, all right, I'm not willing to pay this 28, but I'll pay 25, pay 24. So this is where option trading comes in. Now I have a pretty big position in AT&T across different accounts, so I'll have to kind of walk you through my portfolio. But when it comes to option trading, everybody wants to come in and start buying calls. Everybody's like, oh, AT&T is going to go to 30, so let me buy some calls. So you'll come in here and you click on buy. I'll buy the 30 calls, at $19. AT&T's at 28. By Tuesday it's going to rip to 33, and then these 19s will be worth 100, and if it goes up 3 points. So let's say I bought at 19. Then it goes up, 1, 2, 3 points. That 19 be worth 169. I bought 5 of them, so that's $1,000. So for a $100 investment, I make $1,000 because it ripped from 19, and then I sold them for 156. So the difference between a 3-point move by Tuesday will be that. So everybody wants to do that, but that's not me. I'm not an option buyer. I'm a seller. I'm on the other side. So what I'm saying is, hey, AT&T, you're currently at 28. Even though you're a fair price, I don't like that price. I'd much rather pay 18. But from an option standpoint, if you look at all these options in between its fair price and what's the 5-star rating price, like, there's no premium for selling. Like, for selling, there's no premium in none of this until about right there. 27, 26, 26. So I could get a $200 discount if I just sell that one. And you're probably gonna say, well, $19 ain't nothing. Like, why would you collect $19 today? But to me, it's not. I'm making a little money, sure. But I'm gonna contract to say, like, yeah, you're trading at 28, but I rather own it at 26. So that's a $200 discount. And I could put up some money that I was going to put up today anyway for 28 and put up 26. Or in my case, because it's a margin account, it'll only be $356. So I could put up $356 today, collect $19 right now. Or if $19 not enough, I can go out in time and get $41 by October. So I would say maybe 25. I'll just do 25 for 25. So give me $25 today. I'll put up $255 for $25 today to say that I'm willing to own AT&T at 25. Right? And if you go over here, you see fair value is 26. I'm getting $100 below fair value. That's a good trade. It's a solid company, blah, blah, blah. So this is just one example of what I mean. Let's do another one. Something that costs more that might draw your attention. So say, Apple. Apple. It's at a 3-star rating right now. Let's go to key metrics. We see gross profit margin, again, over 40. Boom, boom, consistently over year after year. You can let them slide close enough. But Apple's good too. So Apple will be a good one. There's other metrics too to consider with like cash flow is a big one to operations, things like that. I haven't really gotten into that yet as far as like what's good and what's bad and all that. But from a high level view, this is the number one thing to go to right here. This is the discount cash flow. Is this a fair price? Apple is trading within the range that's considered fair, so you're not overpaying. It's like a soda. I tell my wife this all the time. You buy soda, you get soda at the grocery store. I don't know, with inflation these days for like $1.50 at the grocery store. But you buy that same damn soda from a convenience store like a Quick Trip, you're paying like $2.50. It's the same soda. Like, why are you paying $1 extra of your money for a convenience of the convenience store where you could just stopped at like a Kroger and got it at a fair price? People will happily take more money from you for something that's not of that value. So think of it that way. Don't be so eager when you go to the stock market to own whatever it is you think you want to own today, and be willing to overpay for it. Like, you're throwing money away, and it took me a long time to realize that's just a bad way to trade. You're not setting yourself up for success long term by doing that. So I'll get off my soapbox. But yeah, fair value is a big one. Another way to get to fair value too is if you want a kind of a back door into Morningstar, you could do like a Robinhood account and pay the $4.99 a month for the gold package. They will give you fair value. Now, I don't know that if they can sneak you in the 5-star pricing, so what the best price is, but fair value is a good starting point. Like, anything under that is. Now, Apple has a huge range between their 5-star 146, 7, and fair value today's, right? So it's a big gap. But regardless, if they're currently trading at 229, that's nowhere near 149. But this is the best price. Like, if we ever had like something happen in Apple or a market drop and it gets anywhere near under 200 or 150, y'all should scoopy up all the Apple you can get because it's a strong company, for example. And there's always opportunity in the market. So if you can't get Apple, boo-hoo, don't worry about it. Go research other companies that are at fair value or better or 5-star pricing. That's when you should buy. The market's going to always create you opportunities, and people will happily sell you things overpriced. So be very careful with that. But even with Apple, and let's use Apple as a good use case of a. Let me give you a visual. So if I go in here and I put Apple. Yeah, I don't have any. This is a good one because I don't really have any lines charts in. So I'm gonna take any drawings off here. And the other mistake you make, if you're going to entertain charting, is people like to look at the 5-day chart, the 5-minute chart, the 30-minute chart. That is not enough price action to be able to trust support and resistance levels or indicators. It's just not. This is when you get into the world of day trading, intraday trading, and you're gonna get burned. You're gonna make a lot of money, but you're gonna lose a lot more. You're gonna get overconfident. You're gonna oversize, and you're gonna lose a lot of money. I'm telling you now. But I'm not trying to tell none of y'all what to do. So if you want to do your thing, you can do your thing. But if you're gonna do charting, I would get as much data you can. Like, get something that's like really, really heavy data driven information, right? And so you can see in here, there's data way back to the late 90s of Apple, which is great, right? And we can probably easily identify some good solid levels here. But let's put on the fair value stuff. Let's put on this stuff. So first it says that Apple at fair value is 210. So let's put that on there first. So I'll come in here and I'll click my horizontal line and I'll click it. And it doesn't really matter because I'm going to come in here and I'm going to put it in by hand, and I'll put 210 and I'll just put the text of fair value. And I just pre-formatted price, value, price. Boom, that's that one. So you see that one there. And then let's do another one for 5-star price. So that's 147. So I'll put that on there. Five-star price. 5-star fair price. Okay, great. And we'll put that on there. Make sure it's at 147. There you go. See that? So, without me drawing any more lines on this chart, you can already see that you're going to overpay for Apple. Potentially. Like, why would you spend $229 on Apple? Apple's a great company and it's wonderful. But, and yeah, it could go to the moon. And that's all it's done over since, the late 80s. But the problem is, like, it's not a good opportunity for you as a new investor to buy here at the top. It's just not. Like, you can go small, but like at least get it at a fair price. So, but not all is not lost. Like, current values at market price is $229. But we as option traders say, you know what? I don't have the patience to wait because Apple will pull back under fair price. But you don't have to wait. You can make money today of fair price, right? So anything in between here is like good pickings. So at the minimum, you got to get it 210. So I would come over here to the platform as option traders. And that kind of gives me a good level to say, all right, let me see if there's any premium at that level. And I would go maybe for the 69 days out. And I'll look and see if there's any premium. But look at this, though. Apple actually has premium all the way down to the 180. All the way down to the 170. So, like, if you want fair value, just get it at fair value. Even at 210, that's $300 right there. 210. Fair value. This is the evaluation of the company at its discounted cost workflow model, that if for some reason you end up owning it at 210, don't be upset. That's a fair price for the company as to be an owner of the company. That's all I'm saying. That's a fair price. And if you get anything in between there, that's even better. Like, you get anything in between all this cheddar, go for it. Hell, I mean, at 147, can I get some money at 147? Let's see. Doubt it. I mean, you get pennies. Close enough. I mean, even way down here at 150, you can get Apple. I mean, people buying it up at 150. They say, like, if I ever have an opportunity to get Apple at 150, let me get it. And they'll give you, you can probably get mid-price, so you can probably get $20 here, maybe definitely $25. You can get filled here. It's at one delta. There's a 1% chance you're gonna get it. That means you get to keep this $25. Now, this goes back to the big dogs. This is the problem. Is this is what we might start the conversation with. Don't buy things that you can afford, right? So if you were to go to buy, let me get rid of this order. If you go to Apple and go to buy right now today and put 100 shares, can you afford this number? Can you afford $11,000 today? If the answer is no, you should not be trading Apple. And this is at a margin account. If you change it to an IRA, that's $23,000 today. Okay, fine. You won't get it at 230. Remember, we talked about you wanted a fair price, which is 210. 210. That's still $21,000 today. This is what I'm talking about. You will lose your money if you trade Apple, right? Like, you can afford Apple at even marginal price. Let me show you margin. So what does that mean? You're probably like, yes, you can. Everybody's gonna say, yes, you can. I could just do a credit spread. Sure, I mean, I can do a credit spread. I can, I come in here and be like, let me get 50 here. And this is what I meant by earlier. I buy options. We could do a defined risk trade, and I do that. And there you go. Now we got $2,000 at risk. We're going to collect $29. You're going to risk $2,000, and you're going to hit go. And you'll do this all day long. The problem is this. Because you cannot afford Apple 100 shares, You have to take this $1,900 loss if you're wrong. That's the problem. On the flip side, you can say, well, I can't afford Apple, so I want to participate in Apple's move in the direction that I thought that I supplement that I had, or my directional bias. You're not wrong. I'm just trying to rewire your brain to say, all right, this trade is something that you could lose a lot of money. Like you could lose 1,900 because you can't afford to own it at any of these prices. You're gonna have to honor your trade, and the money you're risking today you won't get back, and that means you be damned if you're wrong. You're gonna be right 100 times. When that 2 times you're wrong, you're gonna lose $1,900, and that's what's gonna piss you off, and that's how you're gonna lose a lot of money. So this is what I mean by like, don't trade things you can't just buy 100 shares. If you can buy it, you can trade it. Forget about option trading. If you can buy straight up, got the cash, you can do it. So that's the biggest thing I want to make sure we're clear about. So now that we're clear there, I can walk you through my portfolio of what I got going on, and we can see. Now I got a little bit of everything, so bear with me. My account has two. First, we'll go to my IRA account. Here's some positions that I'm trading. I'm dabbling in. Again, I'm a big AT&T trader. I've been doing it for 5 years. It's been a really great journey because I bought it too high. I bought AT&T way too expensive. Like I was the guy that happened to get the money at the worst time. I got the money years ago, where I was like, oh, okay, I got $5,000. I want to buy AT&T. It's a great dividend. So I'm like, buy. But I was the guy that bought it like right around here, like 31, 32. This was probably me right here. Something like around this area. Let me look at the 5-year. Let's see. It might be longer now. But anyway, I was the guy that bought it like way up here, and like every day since I owned it, it said, like literally, that was me. They got me. But it's been a great learning opportunity because I learned about dollar cost averaging. So I didn't panic on its way down. I just bought and bought and bought. Like I bought a lot of it up here, like $5,000 up here. And then I kept dollar cost averaging all the way down. But I also was doing option trading. I was putting on more and more cash secure puts that enabled me to get more and more and more all the way down. And the patience paid off because over the 5-6 years or whatever that I did that, it did this. So fast forward to today, this is where I'm at. Like I own 1,400 shares that I'm up almost 10 grand, 31%, which is great. And then I learned about covered calls. So I was doing covered calls along the way, but making money, and then AT&T ripped, and then I got in the money on everything, which was so upset. I was like, oh no. But then I learned at my core of option trading, and I remembered, wait a minute, there are two types of values that a option has. You have intrinsic value, which is basically the value of the option that is all around the underlying security, which is the strike to the current price. So the intrinsic of this contract to current price is what, $4.08 versus this one is $3.08 and this one's $6.08. So like you kind of see the amount of value of intrinsic, which will never go away, because that's what in the money means when you're on the selling side, is you want them to have zero intrinsic value, which means like Bank of America is a good example. How its current price is 46. I'm shorting the 40, so that has no intrinsic value because the option that I have is below the current price. Okay, and then extrinsic value is the time between to expiration. So that is the amount of volatility. It's the amount of time will determine the remaining amount of value in the option. And so that the intrinsic is my hedge So like I'm hedging for if the stock price drops and this value starts going away, these will become more in value because all the intrinsic will come out of these, and these will go up into profitable. So the difference is the hedge. So this is like insurance on the way down. On the way down. So if it starts dropping from here and starts doing this through all these prices, I have insurance all the way down to 20. Okay, so that's what this is. So no, this is not a bad thing, but you gotta watch these. You gotta manage them. If you don't know what you're doing, if they're in the money, they're gonna pull away my shares. 100 here, 100 here, 300 here, 9 here. They're gonna take them away, and that's not a bad thing. If they get called away for any of these prices, I'm going to make profit. Like from here, from my trade price, which is my trade price is 21.30. So anything between 21.30 and here is profit. Anything from 21.30 to here is profit. Anything from here to here is profit. The only one that I won't be profitable on is this one. I sold a cover call below my trade price, which is very bad. I did this when the stock price was under 20, so I was trying to do covered calls, but I wasn't being. I had mixed feelings on this one. I was just trying to decide, do I want to do pure cover calls or want to do some hedging to lock in profits. So it's okay. But over time, I can manage this and get out of this 20, maybe get it to 21, something like that to kind of close the gap. Or I might not. Who knows? I don't know. The benefit is these will always have extrinsic value. This column right here, they will always have value as long as I'm rolling them out for more time, right? So you just have to make sure you manage these and be careful. So that's what's going on here. These other ones, again, they might be vertical spreads or credit spreads on the underlying. The old me will just let this trade stay as a vertical spread, and whatever way it works out, I will manage it. The new me is only trade stuff that I can afford. Like I can afford Hewlett Packard at 26, right? I can afford this. I can go here and say buy 100 shares, and can walk away and say I can afford this. On my margin account, I only need $1,300, and I have the money. Right, so I could own it at this price, or even on my IRA, it will cost me. There's no margin, so it'll be all of it, but I can afford it because I got enough money in my account to cover the position. So what would I do? I would purely, literally, just if this side goes in the money and threatens to own it at 22, which is a fair price, this is going to be profitable. This is going to go up and have a profit. I would take this off for a winner. This leg of it, I'll take it off, and then this one, I'll let once it expires, I will own Hewlett Packard at 22. Now think about that. Currently, Hewlett Packard's at 26. I want to own it at 22. Let's think about this. If I go up here, fair value is 30. 5-star price 21. So, ideally 21 would be better, but I got that sucker at 22. I'm not upset, right? So 30, I'm already up 30%. I could just take it off. It's not a lot of money. It's like $8. So yeah, I'm probably gonna wait and let that lock in more profits. But this is my point: is like you can hang around fair value people, make your money. And then if I get a sign, then I'll do cover calls. So just like I'm doing AT&T, I'll do cover calls on it. Lock in money that way. This is the Wheel of Fortune. All right, so now let me give you a visual of some charts that I've did for all of them. So we got HP up. So let's do that. So if I come in here, do HP. See, I thought I did. But I didn't do HP. Okay, I didn't do HP. Although HP might be a good one. Let's do it together. We'll do this one together. So I'll take this alert off. So if we come in here and we look to HP, fair value is 30. So let's add that one. So I'll go here. 30. So this is a chart of 90 days. So we need more data. So let's do time frame. Let's see. Let's do 20 years. Monthly, maybe. Let's put a star on it. Boom. There we go. Now this is a good chart. So we could put some lines in here. So we already got, click on this one. It says at 30. Let's modify it. Maybe make it orange at 30. And then this is fair price, right? And then let's see, endpoint. Put out in the future to today or whatever. Okay. So that's that one. And then we want the price to show. Maybe do it to the right, or we'll do it to the left. So that's fair. Let's do it to the right. Nice, so that's fair price. And then the other price that matters for HP is $21 is for the five-star price. So we'll just do 5-star price. Duplicate it. All right, let's do that. Let's edit it. 5-star price at 25. Boom. There you go. So this gives you a visual. And see this, and look how amazing this is. It's like all this, boom, hits the ceiling, boom. So strong resistance, and then bust through resistance. Come back down. Now our resistance now support. So support. Look at that. And now it's hammering around the 5-star price of HP. This is why I chose this stock as a good entry point for me, because all this right here is support. Like it's just sitting on support. So like, you know, if I was at another price line on this chart, maybe do it right. Maybe here is probably a good line of resistance. Hey, boom, keeps hitting it, come back down. Like, someone argued this. To me, this is uncharted territory. Like, I don't trust any of this, because if you go, this is a last 20 years of this of HP. Like, I don't trust any of these pricings. I don't feel good about them. But it's done it before. So buying it right here would mean that it over time could hit $41 again. So this is a good trade, right? Let's look at the financials. Going to key metrics. Looking at summary. So this reminds me of a UPS, right? They no longer have like advantage, like edge in the industry, but it's still a decent profit margins, right? It's like half of a company with edge. So a company with edge is like an Apple. They have edge over their competitors. These levels of 20% is more like they're not going out of business anytime soon. They're still gonna be a well-known name, but yeah, I mean, I'm not sure if you want to own this for forever. You know, first like AT&T, I would rather own that. But regardless, from a not overpaying standpoint, we're currently at a 13% discount to own it. So this is what you should look for. So again, this is a visual of what I'm talking about. And you're more than welcome to draw more support lines. Like I would probably do another one. So I'm looking at all the, grab from the bottom. So I kind of see where they all like intersect. So this might be a good price point there, right? And if you want to do another one, I would probably do one maybe. I kind of see where things intersect. So maybe something like that. And like I'm done with this chart. Like I wouldn't do anything else. Like this is it. So this is charting 101. All right, now let's look at a few more positions that I have on my margin account. So here's some positions that I have here. Let's see. First, let's look at Intel. So we'll come back to XLYB. But Intel, let's see. All right, so that's not Intel. There we go. So Intel, you see, I've already drew the lines on it, so this is perfect. I love it because Intel is trading at, again, this is another example of Intel is trading at fair value price. So this is a good candidate. They're at the bottom of their range. They're trading, if you look at the past, at fair value, which is what, under 27.5. Their fair price is 21. The 5-star rating is $10, which we probably will not see that. This hasn't been that price since 2009. So I don't see us hitting this low, but anytime we can buy Intel at this price below fair value, above 5-star or a range, anywhere in here will be a good purchasing potential. So you see in here, I got Intel at 18. I'm not going to pay current market price. Again, this is about, you have no control over when the market is going to come to a price that you want to pay, but you can leverage those levels. You can leverage people's fear in the market or their hedges to protect their investments, and you can sell them at strikes that you're willing to own it at. So I don't want to own it here. I want to own it here. So one or two things will happen. It never will come down to 18, and I will lock in my $68, or I own it at 18, which at a margin counts what, $900. I'll own it 18, and then I will sell cover calls. So this is what I mean by win-win-win. Either you can be a trader, you can also be an owner. I don't mind owning Intel. If we look at Intel from a financial standpoint and kind of see where they are in the market, let's see. You see Intel is currently trading at fair price, right? And if we look at their key metrics, we're looking at their gross profit. You see they're hitting it, boom, boom, 56, 55, 40. Like they're definitely a cutting edge, competitive advantage company. You compare them to like the Nvidias and the AMDs, but again, they're in a real good place. Not to mention they probably pay dividends. I'm not sure. Let's look and see. Yeah, they pay a very small dividend, but they do pay dividends. I would think they would have a PE ratio. I'm not sure why that's not showing up, but we'll cross that road. So we looked at HP. Let me narrow this down to just be these. So I won't have that many trades on here. I got American Airlines, Intel. Let's look at American Airlines. So I'll go over here. Here's another one that I already charted. You see they are coming back down to their fair value. So we probably could like zoom in on this. So we zoom in. I didn't put their 5-star pricing, but if fair value's at 10.4, 5-star will probably be down here at like 8 or 9 or whatever. Let's just look real quick. American Airlines. Yeah, so their fair value is 10.40, and then their 5-star is 5. So you and I both know American Airlines is not going to drop down to $5 anytime soon. If it does, that would be a deal. I would scoop it up in a heartbeat. Anybody should, $5, 100 shares. I mean, that anybody can afford that. But right now, that's my position. I'm sitting at fair values at 10. I think I got it at 10 if I remember. I have 11. So honestly, on this position, I probably should get out, take my 17% and run, because it's trading at 11.62. Fair value is at 10.40. So I'm about 20 cents over. I collected 46, so I'm covering the 20 cents. So if it does in the money and I end up owning it at 11, the fair value is what, 10.460. I collected $46, so it's be what, 20 cent overpaid maybe. But I probably will take this off. I don't really want to own it at 11, so I probably will take this off for that trade. Intel we already know is a good trade. 18 looking good. All right, I'm right 14%. And then let's talk about this one. So this one was one I was playing off volatility. So if you look at the volatility of this position, it was an earning play. They just had earnings about 2 weeks ago or so. So their volatility was like I'm not sure how much you guys have learned about volatility in the market, and but this is why we sell premium, because fear. The more fear in the market, the more money you can collect from somebody that's fearful. When I put this position on, it was like 76, something like that, maybe 90. So I said, okay, I can collect some premium here. I'm gonna tell you why it drew up my interest. So if you look here again with owning a company at fair value, this is a company that I didn't know a lot about, so I'm trying to be better careful about this. But they're a 5-star rating right now. I mean, they're currently trading at 49. The fair value is at 90. The 5-star is 54. I got it at 50 originally. I rolled my put down to 45. So I'm in a really good price. I'm in a really good discount of this company. We can see it together at the gross profit. I haven't looked yet. So their gross profits. And so this is an example of what I mean by, not good. Their gross profit margins are crappy, right? 9, 11, 12. So this is a stock that I will not, and I do not want to own long term, right? In hindsight, I probably won't do trades like this again when their gross profit margins are this low. They're if you look at on average consistently, they're probably around 12. 12 is on average, which is too low. Like, so I'm not gonna get back in this trade. This trade is gonna be something like once it's done, I'm done. I'm gonna be done with it. But I don't wanna lock in a loss of $200. If you look here, I don't want to lock this in. I'm using my options mechanics and defense mechanisms, and I can still walk out of this trade as a winner, but I'm gonna be stuck in it until Christmas, right? So unless they make a massive move back up, I'm playing on the upside. If you look at their chart, and again, I make my decisions not off their financials, but just off price movement. If I went way back to 2010, their 5-star level is here at 54. So if we look back in the past when it was at these levels, it was back in 2020, right? So they're coming back down to 2020 levels. So I think especially if you look at this 5-star rating, they're pushing down to maybe 44. I think it might get to. Look at this is the support way back in 2011. So either they're going to crash and get back to these levels here, which is way back in the 2010s, or they're going to hit this line and like a support like it did before back in 2020. It came all the way down here and hit it, and then it bounced back up. I think we're doing that again. I think we're going to come in here, and if I'm wrong, then it's going to be a sad day. But if they kind of play around for this level for like another 20 days, I can still come out of this as a winner. Or like if they hang around this through another quarter, kind of hang around. What this basically means, I'm gonna be stuck in this trade for the rest of the year, which I'm not happy about. But from a requirement standpoint, this is holding up about $600 of my account. I think I can handle it. I can. It's more than my other positions. I typically like to stay 5% or less from a position standpoint, but because I'm playing this to the upside, which I play everything to the upside, I'm willing to stay in this trade, and then going forward, like I said, I just like a couple of days ago, I started to consider more, Warren Buffety, more Benjamin Graham financial standards for companies to trade and to own. So bear with me. I'm trying to figure this out. But hopefully by next time I had a video for you guys, I'll be out this trade because I don't want to stay in it. I'm going to play defense. I'm going to play defense on it. it's good. It's really good premium here, probably because of the risk. Really good premium. So I will probably, until the IV, the fear goes out, I'll keep bleeding this dry all the way down to the 40s and 35s. So we'll see. But right now I'm good. The market's not telling me I need to run for the hills. But this is a good learning for you guys, especially margin accounts. You gotta be really careful because when you put this trade on, they're gonna let you put on this trade for 10%, 15% of the actual amount you need. But when the trade goes against you, like this one has been to me, like it's been falling ever since I put the trade on. You see how long this candle is. The margin requirement is gonna go up because remember what I was telling you. If you want to own this thing, you gotta buy it. And if you're gonna buy it at current price, which is not right, let me find the right one here. Let's see. So if you click on it here, oh wow, this thing says 94. No, that's wrong. I wish I could get it for 94. I don't think it's gonna rip like that. So this is after market. This is a Saturday morning, so this is wrong. But right now it's 49.35. So let's say I come in here and put 40 now. It's current price, and you want to own it at 100. The problem is this will be $4,900. I'm sorry. This will be $2,400. I don't want it to lock up or take up that much of my buying power of my account. I mean, I could do it. I could afford it, but which is why I put the trade on. But I still don't want to have to lock up like $4,500 of my money for this trade. So I really want to stay focused and maybe get out this position before Christmas, and then maybe I will look for other opportunities. All right. So one thing to help, and this goes back to option trading defense. If you look at my position or my activity on this trade, you'll see on the options chains that it's currently showing a P&L of 200 and some bucks on this as a loser, right? 231. But that's not really true, right? There's still plenty of time to be right. If you look at my history year to date, you'll see for this position, which is right here, you see it's 211, 20 down, which equals to 231, which equals to 233. But that's not really true in hindsight. My position is still potentially could be, you have realized and unrealized. So I've realized I lost because I rolled, and a roll is basically when you first open the tree. I'll just show you a visual. So a roll, they call it a roll, but it essentially is just opening and closing position. So I started with a naked put, cash secure put to open for $1.05. Okay, $1.05. Collected it that day. It started going against me, so I wanted more time. So to get out, I bought to close the one I had, and then turned around, and this was within like 8 days. It was going against me. It kept coming down, dropping. So it got right at 50. I was on a dance floor, so I closed that out, which they gave me 105 on this day, the 31st of last month. But then I needed like 300 to get out of it, right? So I paid the debit, which is at 211. But to open the next trade was 300 and some bucks. So the difference between closing out the other one for 300 and opening another one for 300 something was $4. So I still have this money. I haven't lost this money. I got $4 more. And then I'm now in a new position. So if you look at the new position, If you look at the new position, whatever, um, you'll see that it's sitting on 330. So over time, as long as I'm right, as long as it doesn't get below, and it still might, but it very well could. But if the stock rallies back up, this will go to zero. This will go to like $30. If it rallies 15 points, it'll be 30 by Friday. It could very well get back to 55 or 50 by next week. Or if it doesn't, if next 100 days go by and it hovers around 55 or 50 and doesn't, and it goes nowhere, I will lock in profits, right? And so at the end of the day, if you do the math, if I still got the possibility of this 330, because that's what they gave me to get out of the other one. Because if you look at the other one, let's see, I think I had the September. See, it's 145. Oh, I had a 50. So you see, it's 360. But then, for more time, you see how it's 580. But I wanted to go down and strike. So if I went, strike to strike, I would have collected even more money. I would have collected 200 and some bucks. But I wanted to go safer. So I took something that was trading around 300 something I'm currently at, to, if you go out another 100 days, that will give me the extrinsic to account for the intrinsic to get in a lower strike. So that's why, I did realize the difference between the two is realized loss. But I did it in a way where I was able to collect like $4 more credit. So that results in a net credit. Net credit, right? So once this goes down to almost nothing, I can keep this $100. Then that's gonna give me a situation where I'll in the end come out on top, right? I'll come out on top in the trade. All right, so that's basically my trading journal for the day. I want to expose you guys to. I hope this thing helps in more understanding and helps you tweak your own trading style, because in the end, you need to do things that you're most comfortable with in your trading style. So I hope this helps you understand and make wise, smart investment decisions to help you be financially free. Until next time, happy trading. Y'all take care.